Good morning, or at least it's morning when I'm recording this video. If it's evening when you're watching it, good evening. I wanted to talk about tying these statements together. And so since the last video, I came in and applied what we learned in test 3 and test 4 to build out the integrated model, the income statement with the appropriate ratios and drivers, the balance sheet with appropriate ratios and drivers. And then you'll remember at the end of the last video, I had already copied across the consolidated statement of cash flows. One thing you'll notice is that I'm out of balance even with history. And so let's go back and see why. Some of these may be helpful to you if you're trying to get things in balance. Remember, I was a bit fast and loose with my revenue build and said 11,000 widgets at $2 each gave me 22,000. Well, this is a good reason to keep this restatement around. I can go back, get exactly what the revenue was, correct that number by pasting a value. Get rid of this for now. And I've gotten that second year of history back into balance. That's great. I also got a bit fast and loose when I was copying the calculations for the cash flow forward. The operating plug was only meant to keep that historical year in balance. So I want to stop plugging things as I go forward. So we'll remove those. And this was then matching history so that our balance sheet would stay in balance. And as I mentioned yesterday, I might ask you about how you feel about the source of those numbers. It's not the most important question I'm going to ask you, but if you have some insight on that, I'd love to hear it. We obviously don't want to plug them going forward. And so that brings me closer to balance, but I'm still out of balance. And I thought it was interesting why, and wanted to share this with you in case you run into the same thing. I'd included this line called Other Assets, and I came down here and made it a percentage of, I think, revenue. Yeah, revenue. And then said that's going to continue to grow with revenue. Well, if those assets are growing, then presumably that's because cash is being spent on them, and so cash needs to come down. If you think about it, it's the same with our current assets, with our net fixed assets, going into the total assets as well. So if we have a new line on here that I didn't have in the model, if you have a new line from your restating that you didn't have in the pro forma practice model, and you need to account for the change in that line to keep your balance sheet in balance, be sure to account for that cash on the cash flow statement. We could do it by assuming that they were current assets. Just make this adjustment larger by the amount of the increase in total other assets. That would bring this year into balance. But if they were really current assets, then they'd be up in this line instead of in this line. So I'm going to assume that they were some type of investment that did not go onto our depreciation schedule or some type of financing, and account for that change by creating a new line in the financing section and assuming that that's what those other assets represent. I'd really need to go to the notes and find out, of course. But if instead of, other current assets, if instead of taking them out of the operating cash flow, I took that change here, then I would still be in balance. And so again, I'd really need to go to the notes and find out what those other assets represent so I'd know where to put the change in them on the cash flow statement. Now, it's encouraging that I'm in balance from here on out. I only changed 1 year. But notice that's because these other assets that have been our problem are not changing in future years. And so let's come up to the revenue, which drives them, and say we're increasing every year. Then I only fixed 1 year of balance. To fix the remainder, I would have to come in here with a Control R. And then we've applied that change to all years. So that was a bit of a segue, but if you're having trouble balancing your balance sheet, your model, and it's because you've added other items on the balance sheet that were not in our pro forma practice, then hopefully this most recent video has been helpful. At this point, I'd like to move on and talk about capital expenditures, and in fact, some of you have talked about government-backed loans with all this bailout conversation going on, or government equity support. So first, let's think about this capital expenditure line. And all these are going to be inputs or perhaps tied to your dashboard. So I'm going to make that clear to us that these are just values that we're inputting. And so in the previous video, I think I talked about what happens if we make a capital expenditure. Well, it changes our fixed assets at cost. So that capital expenditure gets added to fixed assets at cost. This was in the video. I think I made a comment about an iPhone or something. And then it goes up by that amount. I'm going to copy that over before I forget to reflect all those capital expenditures. Hopefully all of you are considering capital expenditures. And the way that affects our model is if we do an Alt-M-D to see what depends on it, we find out that the net fixed assets depend on it, and the increase in fixed assets depend on it. And so that change in fixed assets at cost down here reflects the capital that we spent in 2020, 2021, and 2022. Where does it go from there? Alt-MD shows us that it goes to our total net change from investing activities, of course, and eventually down to our total increase in cash and cash equivalents, and our ending cash balance, which I'm going to remove arrows before hitting Alt-MD one more time. And as you know, that goes right back up to the top of our balance sheet. And that's why when we increase our fixed assets at cost, we get a corresponding decrease in cash. Similarly, if the government were to give us a loan, let's say, let's do a big number so it shows up quickly. It shows up easily. Government-backed loan of $5,000. How would we accommodate that on the balance sheet? Well, we'd say that our debt, instead of remaining constant like it did in pro forma practice, this time our debt is going to be increased by the amount of loan. It doesn't have to be a government-backed loan. It could be a CFO decision to take on more debt in the company or to pay down debt. We could put a negative number there. And then what happens? It flows through the cash flow statement just like the change in fixed assets did. There's a change in debt on the cash flow statement, and to keep things in balance, notice our cash went up even more. And better copy that formula across in case we decide to change our debt in the future. By the way, this idea of holding debt constant, presumably we're paying down our debt each year, but if we're choosing to hold it constant, then we're making an assumption that we're taking on that much new debt if we hold it constant. If you wanted to just pay down your debt, if you wanted to look at your company's debt schedule and pay it down and not take any new debt on, do that here again by putting a negative amount that gets added to your debt. It wouldn't be government, it would just be you paying down debt. This is you taking on debt. It just happens to be government because that's the reason I brought this up. And let's say you choose to issue equity to the government or anyone else. Then if you issued $10 billion in equity, we're getting ridiculous, but it helps it show up on the statements. Then what would we change down here? We'd come to our balance sheet and we'd say stock has now changed. It's the number that it would have been plus the additional shares that we issued, or dollars of shares that we issued. If we wanted to buy it back, we'd put a negative number on this line. And look what happens now. It flows through the cash flow statement back around to cash, and cash is now increased by $10 billion. These numbers haven't been exact because it's also changing our interest a little bit. To issue equity, we have to assume a share price, and so we haven't talked about forecasting share count. I think what we've done in the past is either held our share count constant, or we have grown our share count by some historical growth rate, or bought back shares by some historical decrease rate. And what we're doing when we do those is we're assuming that management will continue to act like it did. These numbers are absolutely under our control. Okay, we can issue shares or buy back shares all we want. What's not under our control is the share issue price. And so let's say that we issued a price at, I don't know, our numbers are getting ridiculous here, but $20 a share. And so then what happens here? We have the shares that we had before plus the amount of money that we raised by issuing equity divided by the share price. The dollars per share results in shares. So to issue $10 billion of equity at $20 per share would cause our share count to go up correspondingly. And I would assume that diluted share count goes up by exactly the same amount. Copy those forward. Can't divide by 0, so we need an if statement. And so then if we came out here later and bought all that equity back at a lower price, our if statement would not see that as non-zero. So if statement needs to say greater or less than 0. As long as we're not dividing by 0, we're okay. And so if we bought back a tremendous amount of equity at a very low price, we'd have a very small number of shares remaining. I just want to check one last thing. It's important that when we calculated that change in stock here, that I carried that forward, and I did not. So memory served, we'll copy with Control R. And then if we bought back shares at a lower price than we issued them, that's the kind of thing that leads to negative equity in this line on your balance sheet. So again, this is more of a lecture and less of a prepared video, so I hope it wasn't too clunky. I hope it was helpful. Questions welcome.